where they'll be both below 20% and almost with very similar levels of taxation. And so Ontario is actually a really good news story, I think, for Canada as a whole, because not only is there sales tax harmonization, but Ontario is eliminating the rest of the capital taxes that are paid by businesses there, and they're moving down to a 10% corporate income tax rate, very similar to Alberta. Same story in British Columbia, where you see a very sharp reduction in the effective tax rate on capital as a result. Now I should mention, I forgot to mention one other important point here. In these numbers, we do not include oil and gas and mining sectors. There's a reason for that, and that's because of the complexity involved with royalty regimes. In fact, recently, I'll say a few words about that later. Recently, I've been spending a lot of time in oil and gas taxation and royalty systems, and in fact, we'll be Donji Chen, who works with me, who's in Washington, we will be putting out some new numbers. We're a new paper very soon on oil and gas taxation. But those numbers are not included, and I'll say some things about the bias involved with that. But as you can see, when you look at 2013, which is the white column, you'll see that virtually Alberta will no longer have a tax advantage on capital investments, except with respect to Saskatchewan. Saskatchewan still has a capital tax. Saskatchewan will still have a higher corporate income tax rate, at least as planned right now. And they still will, and Saskatchewan so far will not do sales tax harmonization. So Saskatchewan's really hurting themselves, actually, on a policy side with respect to capital investments. And they are actually going to be at a disadvantage in Canada. And the same thing is true for Manitoba, where they will also have not agreed yet to go to move towards sales tax harmonization. But who knows, that might change in the next short while, given what BC and Ontario has done. And of course, little Prince Edward Island, well, they're out of sight. Anyway, one of the interesting provinces, though, is New Brunswick. New Brunswick actually is going to have the most tax competitive regime in Canada when it comes to capital investments. The new government has adopted a plan of lowering corporate income tax rates from 13% to 8%. So New Brunswick will actually, in the next few years, will have the lowest corporate income tax rate in Canada amongst all the provinces, which is quite interesting. They've also are eliminating entirely the capital tax, and of course they undertook sales tax harmonization over 10 years ago. And of course some studies have shown how capital investment has really been boosted up in the three Atlantic provinces that had undertaken sales tax harmonization. And you can see that New Brunswick has certainly benefited from that. The Atlantic provinces also benefit from one other provision, and that's the federal Atlantic investment tax credit that's available for resource and manufacturing companies, and that does drive down their effective tax rate tremendously on the assumption that it's fully used, which is not always the case. In fact, in my view, it's about time the federal government started looking at that Atlantic investment tax credit and ask whether this is really the appropriate policy that should be used in the long term. So on the capital side, the answer now is that by 2013, Alberta will no longer have a tax advantage when it comes to the taxation of investment. Now, this is just to give you an idea of industry differences. Actually, I thought this just to show you that we do these numbers, and as I mentioned, we don't do oil and gas, but you can see that in Canada we still have a bias towards manufacturing and the forestry sector in terms of very low effective tax rates in capital, and we still tend to tax services much more highly than other sectors in the economy. And of course, I think that has some long-term impacts about productivity and the use of resources in the economy. Somehow I don't, I think this is, there was some, this is not actually the one that I had. Anyway, let me, I'm going to be flipping through these because there are some of these that should have been deleted. Anyway, the one is figure 2A. This is now the important one, which is now the marginal effective tax rate on labor across all the provinces. And here you can see this is where Alberta has a significant tax advantages with respect to the taxation of labor. Now, just to give you an understanding what the marginal tax rate on labor is, it's the idea is that if somebody works an extra hour, how much extra tax, or how much tax as a share of their of the income that's paid to workers is being taxed, either through personal income taxes or through payroll taxes. Several of the provinces have general payroll taxes. It also includes, very importantly, also sales taxes, because what people forget about is that, you know, when you earn your income and you go out and you buy goods and services, you also pay tax on those goods and services, and so that's just like being taxed on your worker, on your labor income, and it's very important to remember that consumption taxes are also a tax on labor. Now, now with respect to Alberta, generally the Alberta. Now, I should also mention the way we do these calculations is really quite sophisticated. We actually have a distribution of worker earnings across all the different industries, and we actually measure the marginal tax rate that applies to each type of worker in each province, and then we do an aggregation. And so one of the things that comes out of that is that provinces with, let's say, richer people, or let's say on higher income levels, they tend to have higher marginal tax rates as a result. And this is the case of Alberta, because actually the higher income levels in Alberta doesn't mean that there is a higher marginal tax rate at the personal level. But generally, Alberta's big advantage with respect here is really fourfold. First of all, Alberta has just a flat personal income tax rate of 10%, which on the upper skilled or higher skilled workers in the Alberta economy is a very significant benefit living in Alberta relative to other parts of Canada. There is no general payroll tax in Alberta, so that's another significant benefit. And third, there are some commodity taxes, excise taxes, but generally there's no Alberta sales tax, which is another important advantage. So those are three elements which give a very important advantage in terms of being in Alberta. And as you can see, there's basically a 6% advantage, at least today, as of 2009, in terms of average marginal tax rates of living in Alberta compared to other provinces. So this is the big tax advantage that's in Alberta, and in fact that's the one which I want to refer to some more later. These are some calculations we do by industry. You can see retail trade, you get very low marginal tax rates. That's reflecting the low incomes that are earned there and the fact that there's low personal tax rates that apply in that industry. And you can see when you get into communications, you get very high marginal tax rates on labor, which reflects the income levels there. Let me just stop with one final point, and these are the marginal effective tax rates on cost by province. This is with respect to Alberta. This is the idea of the effective tax rate on cost is to aggregate these two tax rates together. And you can sort of think of it, there's a cost of doing production in each province, and that depends on the use of labor and capital. And with that cost of production, included are taxes that affect those costs, all sorts of taxes that we've calculated in these numbers. And so the effective tax rate on cost is just really an aggregation of the effective tax rate on capital and the effective tax rate on labor, depending on how much labor and capital is used in each industry, et cetera. And this is the final sort of calculations we do. And as you can see, Alberta will have an advantage. And unfortunately, I didn't put in the 2013 number here. There is actually another slide that didn't get included. But what you would find here is that Ontario one is going to dramatically fall, but not go as low as Alberta. So Alberta, as of 2013, will still have an advantage, but it will be with respect to taxation of labor and not with respect to the taxation of capital.